Okay, I want you to picture a true titan of industry, a company that seemingly had the entire world in the palm of its hand, riding this massive wave of unprecedented global demand. Their core product was sitting in millions of homes, their financials looked like a tech investor's absolute wildest dream, and their valuation was just skyrocketing to these dizzying, unbelievable heights. I mean, they were untouchable. Or, so they thought. Welcome to this explainer. Today, we are diving deep into a real financial thriller that completely shook Wall Street. We're talking about a story of extreme hubris, massive capital destruction, and one catastrophic blind spot that brought an absolute juggernaut straight to its knees.
So you really have to ask yourself, how does a $50 billion titan just lose $4 billion of its market cap in a single brutal 24-hour period? And look, this wasn't some slow, painful bleed. This was a sudden, violent financial hemorrhage. And what is truly mind-boggling about all of this is that it wasn't triggered by a global financial crisis, right? It wasn't a sudden spike in interest rates or even a fierce new competitor stealing away their market share. No, it was triggered by their own management's response to a completely avoidable crisis.
$4 billion. I mean, just let the sheer crushing scale of that number sink in for a second. Billions of dollars in shareholder value effectively vaporized from the balance sheet between the opening and closing bells. It stands as one of the most stunning capital wipeouts in modern business history. But to truly understand the sheer gravity of this collapse, we kind of need to rewind a bit. We have to go back to a time when this mystery company could do absolutely no wrong.
Chapter 1. The perfect financial climb.
All right, let's pull back the curtain here. The mystery titan is Peloton. Now, before the massive fall, they had basically cracked the code on consumer behavior. To the untrained eye, sure, this is just a stationary bike, but to financial analysts, man, this was a Trojan horse. Peloton wasn't just selling you a piece of high-end, sleek exercise equipment for $2,000. They were selling you a portal. As millions of people were locked down and stuck at home during the pandemic, this bike became a status symbol, a fitness studio, and a social network all rolled into one entirely new category. They created a product so sticky and so heavily coveted that they literally could not manufacture it fast enough to meet demand.
And you can see it in the numbers. Their quarterly total revenue was just this aggressive, straight staircase up. By Q3 of fiscal year 2021, they hit a staggering $1.26 billion in a single quarter. Think about that. They literally doubled their revenue from 2019 to 2020, and then they doubled it again to over $4 billion annually by 2021. They were a fitness company. Actually, scratch that. Wall Street was pricing them as an invincible tech juggernaut. But here is the absolutely crucial part. It's how they actually made that money. On one side, you have the connected fitness revenue, right? That's the one-time sale of the physical bikes and treadmills. But the real magic, the secret sauce, was the subscription revenue. $39 a month, month after month, with incredibly low churn rates. People bought the expensive hardware and they felt locked in. This created a lifetime value to customer acquisition cost ratio, the LTV to CAC, that was legendary in the investment world. Their balance sheet looked, for all intents and purposes, bulletproof.
Chapter 2. The warning and the hubris.
So right at the absolute peak of their power, when they are sitting on this $50 billion valuation and feeling entirely invincible, a massive blind spot emerges. In April 2021, the Consumer Product Safety Commission drops an absolute bomb. Federal safety regulators were publicly imploring consumers with small children or pets to immediately stop using Peloton's premium treadmill, the Tread Plus. Why? Because there had been a really tragic death of a child, alongside nearly 70 reported incidents of injuries associated with the machine's design. In the business world, this is a 5-alarm fire for any consumer hardware company.
Now, any crisis management expert is going to tell you that the correct response here is immediate cooperation and empathy. But instead, then CEO and founder John Foley goes to war. He actually issues a statement saying Peloton was troubled by the CPSC's press release, directly calling it inaccurate and misleading. He even told customers there was no reason to stop using the Tread Plus. It was, quite frankly, a masterclass in corporate hubris. He literally challenged the federal government on a matter of public consumer safety.
Unsurprisingly, that did not go well. It took weeks of intense public backlash, plunging stock prices, and widespread media condemnation before Foley finally reversed course and issued a belated apology. He admitted, "Peloton made a mistake in our initial response. For that, I apologize." On May 5th, they finally agreed to voluntarily recall both the Tread and Tread Plus models. But by then, the damage to their pristine, luxury brand reputation was already done. The illusion of perfection was totally broken. The immediate financial cost of that recall? Roughly an estimated $165 million in lost sales and refund expenses. But here's the thing. That $165 million was just a tiny surface fracture. The reputational damage triggered that massive single-day stock sell-off we talked about at the beginning, wiping out $4 billion in market value in a flash. And when a massive company bleeds like that in open waters, well, it attracts sharks.
Chapter 3: The Activist Investor Attack.
So, as pandemic lockdowns start easing up and gyms reopen, Peloton finds itself sitting on massive, unsold inventory they had completely over-manufactured during the boom. The stock just nosedives. Enter Blackwells Capital. Interestingly enough, Blackwells owned less than 5% of Peloton's shares. They were just a minority investor. But they published this ruthless, highly public 65-page teardown of Peloton's management. Their opening salvo, highlighting that under John Foley's leadership, total shareholder returns had plummeted by a catastrophic 76% in just one single year. They weren't just complaining on an earnings call, they were launching a full-scale corporate rebellion.
Blackwells literally surgically dismantled Foley's track record, zeroing in specifically on his incredibly poor capital allocation. They called out his baffling decision to drop $431 million, acquiring a troubled commercial fitness company called Precor, which was completely outside Peloton's core consumer market. They pointed to a massive $800 million blown on acquisitions and capital expenditures, which looked like it was driven by pure pride rather than financial prudence. And most damningly of all, they showed how Foley blatantly ignored glaring warnings about overbuilding supply, arrogantly assuming that the pandemic-level demand was just going to last forever.
So, what was the ultimatum? Blackwells laid out two firm, non-negotiable demands. First up, fire CEO and founder John Foley immediately. They strongly argued his lack of leadership and his execution errors were actively destroying the company from the inside out. Second, immediately put the company up for sale. They explicitly named major tech and media giants, think Disney, Nike, Apple, as potential buyers, arguing that integrating into a larger ecosystem was literally the only way to salvage whatever value was left in Peloton's brand and subscriber base.
Chapter 4: The Staggering Financial Freefall.
That intense activist pressure, combined with some genuinely horrible earnings reports, triggered a complete structural collapse. It is honestly breathtaking to see how fast a $50 billion empire can just unravel. Let's look at the timeline. April 2021, Foley defiantly denies the CPSC warning. May 2021, we get the humiliating reversal and the product recall. Fast forward to January 2022, the financial bleeding is so incredibly severe that Blackwells launches their aggressive activist attack. And then just weeks later, in February 2022, John Foley, the visionary founder who built this company from a Kickstarter dream into a Wall Street darling, is forced to step down as CEO. In less than a year, the entire narrative completely flipped upside down.
Chapter 5: The Unforgiving Aftermath. The pandemic party was officially over. The company was bloated, it was bleeding cash daily, and suddenly it was leaderless. So the board brings in Barry McCarthy, the former CFO of Spotify and Netflix, basically begging him to try and stop this sinking ship. But man, the math he inherited was absolutely brutal. At their absolute height, the stock traded at over $162 a share, giving them a valuation approaching $50 billion. By January 2023, that exact same stock was trading for less than $10 a share. The company was valued at roughly $8 billion. That is a mind-numbing destruction of wealth. They fell all the way from a high-flying tech valuation right down to the harsh, unforgiving reality of a struggling hardware manufacturer.
To try and stop the massive cash burn, McCarthy had to initiate a severe turnaround strategy. I mean, he slashed thousands of jobs, he completely abandoned Peloton's long-held strategy of owning their own supply chain, opting to outsource all manufacturing to Taiwan. And in a deeply, deeply humbling move for what was once considered an exclusive premium brand, they started selling their bikes on Amazon just to clear out the mounting inventory. They even introduced rental options, basically doing whatever it took just to get hardware into people's homes and hopefully capture some of that reoccurring monthly subscription revenue.
Which really just leaves us with this final lingering question. Can a shattered $50 billion brand ever truly reinvent the wheel? Look, Peloton undeniably transformed how the world works out, but their story is a brutal financial lesson for all of us. It shows that no matter how incredible your product is, poor capital allocation, arrogant leadership, and a stubborn failure to listen to warnings can wipe out billions of dollars in a matter of months. Is Barry McCarthy's radical restructuring enough to save them in the long run, or did one massive, stubborn blind spot permanently derail the entire fitness revolution? Something to think about, right? Take these lessons with you. Thank you so much for joining me on this explainer, and I'll catch you in the next one.